So, what really separates the top 1% of traders from, well, everyone else? It's not some secret algorithm or a magic stock picking trick. It's a mindset. It's a whole framework for making decisions when the pressure is on. So, let's dive in and unpack how these pros think. A framework that shifts you from just chasing wins to building real long-term profitability.
It's the million-dollar question, right? We've all heard the scary statistic. Something like 90% of traders end up losing money. But why? I mean, what is the fundamental mistake that so many people make that the pros have figured out how to avoid?
And here it is. This is the answer. Most people are completely fixated on this, the thrill of the win, that beautiful green chart going up. They're trying to be right. But here's the secret. Professional trading has nothing to do with being right. It's about being profitable. And that means you have to embrace the math, not just the feeling of a win. And that leads us right into the single biggest mistake that separates the amateur from the professional. It's this huge difference in what they're trying to achieve. One is obsessed with their win rate, while the other is disciplined about actually winning. And trust me, they are not the same thing. This slide just lays it out perfectly. On the left, the novice trader is always asking, what's my win rate? Look, you can have a 90% win rate, but if those 10% of losses completely wipe out all your wins and then some, you're still losing. The pro, on the right, asks a totally different question. What is my expected value? They know they can be wrong, even most of the time, and still be incredibly profitable, as long as their wins are way bigger than their losses. Okay, so let's build on that idea. If the pros aren't so worried about their win rate, what are they focused on? Well, they're focused on building a risk and reward engine. They are obsessed with the math, specifically the math of not going broke, the math that lets them stay in the game long enough for their strategy to actually work. First up is that term we just mentioned, expected value, or EV. This isn't a gut feeling or a hot tip. It is a cold, hard calculation. It literally tells you, on average, how much you can expect to win or lose for every single dollar you put at risk. A pro will simply not take a trade unless it has a positive expected value. Period. End of story. And next up is the one concept that keeps every single professional trader humble: the risk of ruin. This is the real statistical probability that you could lose everything, that you could blow up your entire account. And this leads to the most important rule in trading. A pro's number one job isn't to make money. It's to manage their risk of ruin so they can live to trade another day. Survival is the strategy.
So how do they manage that risk? Well, one of the key tools is something called the Kelly Criterion. Think of it as a formula that helps you figure out the perfect bet size. It finds that sweet spot, between betting too little and not really growing and betting way too much and risking a total wipeout. It's all about maximizing your growth over the long haul by making sure no single bad trade or even a bad streak can knock you out of the game.
Okay, so you've done the math, you've sized your position. But a trade isn't a set it and forget it kind of thing. Not at all. Professional traders are more like pilots. They're sitting in the cockpit, constantly scanning their instruments, managing their position in real time. So what are they looking at on that dashboard?
And this is the perfect way to think about it. You hear options traders talking about the Greeks, delta, theta, vega, and it sounds super intimidating. But forget the complex math for a second. Just think of them as the gauges on your dashboard. Each one is giving you critical, real-time information about your flight, about the different risks your trade is exposed to right now.
And here are three of the most important gauges you're watching. First, you've got theta. Think of this as a ticking clock. It's draining a tiny bit of value from your option every single day. So you have to ask, is time on your side or is it working against you? Then there's vega, your turbulence meter. If volatility suddenly spikes, how much is your position going to jump around? And finally, you have delta, which is basically your compass. It tells you how sensitive your trade is to the market's direction. A pro isn't just watching these gauges, they're constantly adjusting their controls based on what they see. All right, so you've got a great strategy, you're managing risk, you're watching your gauges, but you can still lose money. How? Because of all the hidden costs that can quietly bleed your account dry. Think of it as a slippage tax that you're paying on every single trade, often without even realizing it. The biggest hidden cost, by far, is the bid-ask spread. It's just the tiny difference between what buyers are willing to pay and what sellers are willing to accept. But as you see on the left, a wide spread is like paying a huge toll every time you get on or off the highway. It's a massive cost to trade. That's why professionals actively hunt for tight spreads on the right. They know that keeping these little transaction costs as thin as a razor's edge is absolutely essential. And this all boils down to a couple of key things. First is liquidity. Basically, are there a ton of buyers and sellers? Because when there are, spreads get tighter. And that helps you minimize slippage, which is that awful surprise when you click buy at, say, $10, but your order actually gets filled at $10.05. These tiny little costs seem like nothing, but believe me, over hundreds or thousands of trades, they can literally be the difference between a winning year and a losing one.
So we've talked about the math, the mechanics, the risk management, but we've saved the most important and by far the most difficult piece of the puzzle for last. And it has nothing to do with the charts or the numbers. It has everything to do with the person staring back from the screen. Because in trading, the final boss is you. This slide just captures that internal battle perfectly. Over on the left, you've got the problem, our own brains. They come hardwired with all these cognitive biases that make us do totally irrational things under pressure. And on the right, you have the solution. You have the weapon you use to fight back against your own worst instincts, a systematic, data-driven, quantitative journal. Let's just look at two of the biggest mental traps. First, recency bias. This is what makes you chase a stock that's been hot for 3 days or totally panic after one bad loss. You're basically assuming what just happened is going to keep happening. And then you've got loss aversion. We are wired to feel the pain of a loss about twice as strongly as the pleasure of an equal gain. This is what makes us hold on to losing trades for way, way too long, just hoping they'll come back. So here's the most crucial takeaway of all. In trading, you cannot trust your feelings. You just can't. But you can trust your data. A quantitative journal forces you to be objective. It's the hard evidence that tells you whether your system is actually working, even when your gut is screaming at you to do the exact opposite. It is the ultimate antidote to your own biases. And really, that's what this all comes down to. The 1% framework isn't about finding some magic formula. It's about the relentless day-in, day-out discipline of managing your risk, understanding your numbers, minimizing your costs, and mastering your own psychology. It's the commitment to making those slightly better decisions over and over and over again. That's the edge.